Is the Fed causing a housing crash? Can they do that single-handedly? Well, the Fed caused the crash in 2008 and 9. Granted, it was the subprime lending that was the root of the collapse in the housing market. It was the issue of the housing market collapse, but the Fed is the one that created it by driving interest rates low and pushing housing and affordability of housing out to the public. Right now, they are killing the affordability of housing because there's so much demand. There's lack of supply, especially right now when the supply chain is so constrained. But interest rates have been so low, it's driving huge demand in the housing market. So that's creating inflation in housing prices, inflation in materials, labor, things like that. We are starting to see hyperinflation at the asset level in the markets and housing, and it's going to hit home in the streets. It's already happening at the pumps. And with vehicles, we can't get chips right now because of supply constraints. So even automobile dealers are having trouble keeping inventory, so prices of vehicles have gone up, and the options and choices are down, just like housing. So as the interest rates have been driven down and the government keeps spending and issuing treasury to pay for the spending, issuing treasury notes, those rates the Fed's come in, bought those notes and kept the rates low. Now it's going the other way with all of the stimulus that's out there, infrastructure bill that's in process right now, $2 trillion. They're going to have to issue treasuries to pay for that. They're planning tax hikes to kind of offset some of that spending. That's not going to cut it. It's going to have to come from issuing treasuries. Investors that are buying those treasuries are wanting a higher yield on that because they are seeing more and more risk with the more that we borrow and the more spending that we do. So those rates are going up, which is affecting mortgage rates. Mortgage rates are up. Refinance demand is already down, but housing demand is still high because there's not very many of them. And then as soon as rates start rising, that will create a reverse cycle where housing is going to kind of tank a little bit, values will come down, and the whole process will get reversed. So it is all on the Fed's shoulders. The Fed single-handedly tanked the housing market in the beginning in 2008-9 because they drove rates down, which increased demand and increased hyperinflation in housing prices. And as soon as the rates went up, everything crashed. So we're looking at the same thing happening again right now. So just keep your eyes on it. Same thing's happening in commercial, especially at the multifamily level with cap rates where they are. It's very, very concerning times for the values of real estate at all asset types and classes. So watch those interest rates, be careful out there, be smart, and make sure that you are getting in and out. If you're flipping, if you're building spec, and if you're long-term, make sure that that free cash flow covers debt service and can repay equity.